All right, let's talk about recording accounts receivables and the different types of recognition that we would do. The first one is the most obvious one because it's the one that we've done the most of, and that is the sales on credit. When we sell something on credit, how do we record that? And we know that if we sell a service on credit, then we're going to debit AR for that amount, and then we're going to credit the service revenue for that amount. If we sell a product, then we're going to debit AR for that amount, and we're also going to credit sales revenue. Should say sales revenue, not service revenue. And then we're also going to debit COGS and then inventory. So again, that's just a review of what we should already know that we've talked about in the previous videos. There's inventory right there. Now let's talk about some different ones. Now, normally in my class, I talk about how accounts receivable is not necessarily exactly like a credit card because there's a different layer in accounting in credit cards that you have to keep up with. A straight accounts receivable is more kind of like a bar tab, where you just go in there and say, hey, put this on my tab and I'll pay it at a later date. Credit cards add this different piece that you have to keep up with. So let's talk about that different piece now. Let's talk about credit cards and kind of why they're different. Sellers allow customers to use third-party credit cards for a variety of reasons. And these are the reasons why a company would choose this, to allow their customers to use that or allow them to use credit cards to pay. One, the seller doesn't have to evaluate each customer's credit standings. When you use a credit card, if you go to a store or whatnot and use a credit card, they're not going to ask you for your credit score because they're not worried if you're not going to pay. The credit card company is going to pay them, and you, the customer, will pay the credit card company. So the company that you're purchasing from is guaranteed to get the money. They're not worried about that, so they don't have to worry about your credit standings. They also avoid the risk of extending credit to customers who may not pay. That's exactly what I was talking about. They're going to get paid. The business is going to get paid. It's the credit card company that assumes the risk of not being paid. Another one is that a seller typically receives cash from the credit card company sooner than had it granted credit directly to the customer. The customer is going to pay whenever they can. Now, they could pay at the end of the month, but a lot of times they don't. They may be paying like minimums here and minimums there, whatnot. But a credit card company will pay the total amount that they are exposed to the company by the end of the month, so they get their cash quicker, and that's key, especially in business. Cash is king, so you want to get your cash quicker. Another big advantage is a variety of credit card reasons for customers offer potential increase in sales volume. There's many studies out there that show that when you allow customers to use a credit card, they're going to spend more because they don't see the physical, they don't feel the physical reaction of giving money that they've worked for, giving it up to get the product. When you pay with a credit card, you're just putting in there, you get to keep the card and the product, so you don't get the same physical reaction that you would when you actually use cash. So they know that you're going to be able to spend more, you'll be willing to spend more with a credit card. Now, going back into all this stuff is good for the business, but nothing is showing any disadvantage for the business for allowing your customers to use credit cards. So where does that come in? If they're going to get all this good stuff, they're going to have to give up something. And so what happens is that in order to receive these benefits, most credit card companies are going to choose or charge a fee of between 1 to 5% of the gross sales to process the transaction and to pay the seller. So in order to get all this extra incentives that we just talked about, where you don't have to run the risk of them not paying, you're going to get your cash quicker, they're going to spend more. In order to get that, you're going to have to give up 1 to 5% of what you sold in order to guarantee that. And a lot of times that's not a big issue. 1 to 5% is not much to be able to guarantee it and not have people not pay you. So let's look at an example of how we would do the journal entry for a credit card. So India Company received a payment of $1,500 via credit card. The credit card company charges a 5% processing fee for that transaction. At the end of the month, the credit card company remits the full amount due to Indigo Company. It should say India. I must have mistyped that. And journalize these entries. So the first one is we received this payment of $1,500 via credit card. So that means we sold something that our customer has used a credit card to pay. So let's go ahead and start that. It's an AR. More specifically, this is an AR for the credit card company. This is not an AR to the customer because this is more guaranteed. So, but we're not going to get the full $1,500 because they are going to charge us 5%, and 5% of $1,500 is going to be $75. So we need to take that out because that's what they're actually going to pay us, is the $1,425. We also have the revenue side, the service revenue. That's the $1,500 because that's what we actually earned in this process. So we earned $1,500, but we're only going to receive $1,425 because we're going to have to pay that 5% processing fee. Now, where does that extra $75 go? Well, we're just going to call that credit card fee or credit card expense or banking expense. I'm not sure why it says banking. It really should say credit card expense. But we're going to put that into an expense nonetheless, because that is what we have to pay in order to use the credit card services. So that's how we deal with a credit card journal entry. Y'all take care.